Hello and welcome to Earnings Echo. We put together the most important information about new holdings. Today we're doing a deep dive into their Q1 2026 earnings release, the management call transcript, and some review notes from Stock Market Nerd. Our mission is to unpack how this digital bank hit just massive financial milestones while, frankly, defying traditional banking
Right,
economics.
so let's jump straight into the hard facts here.
Yeah.
Revenue topped $5 billion for the quarter. That is a huge milestone, alongside crossing 135 million customers.
And looking at the bottom line, net income exploded to $871 million. But what really stands out is their efficiency ratio, right? It
Mm.
dropped to a record low of 17.6%,
Exactly, and just for context, that means it cost no one less than 18 cents to generate a single dollar of revenue.
which is an incredibly wide margin. But looking at the forward guidance, management actually expects that efficiency ratio to climb back up to around 20% for the full year.
Right, and you might wonder why they'd actively choose to run less efficiently moving forward. Well, digging into the call insights, two-thirds of that Q1 efficiency beat was just cost timing.
So, delayed marketing and return to office spend that just hasn't hit the books yet.
Exactly. The rest of that budget is deliberately going into U.S. expansion and, crucially, a massive AI infrastructure build-out.
Ah, right, the AI infrastructure,
Yeah.
which is exactly what's driving the permanent structural efficiency gains here. Instead of scaling by hiring thousands of loan officers, they're deploying their proprietary foundation model, Newformer.
Right, and we really need to look at how Newformer actually works, because it's actively evaluating and pricing personal loan requests by calculating the net present value.
So it's factoring in future interest and, the probability of default.
Precisely, and it does this entire calculation in under a single second.
Under a second. That's wild speed for underwriting.
It instantly cross-references thousands of real-time data points from a user's transaction history to dynamically price the risk, so they can handle millions of new customers without massively expanding their underwriting department. Plus, their internal AI assistance has already boosted engineering throughput by 50%.
Okay, but we have to address the risk metrics here.
Yeah.
Because approving loans in milliseconds using AI sounds incredibly efficient, but I noticed their early delinquency rate, meaning loans 15 to 90 days past due it, crept up to 5.0%.
Yeah, you can't talk about rapid credit growth without looking at the defaults.
Right, and their risk-adjusted net interest margin dropped slightly because of that.
Hmm.
Did management sound concerned on the call about this uptick?
Not really, no. They attribute it largely to normal Q1 seasonality, but also to a highly intentional strategy. They are deliberately expanding into higher-risk customer segments.
Which sounds incredibly dangerous on paper for a bank growing this fast.
It does, but they argue their AI models are now accurate enough to confidently predict those defaults and still price the credit profitably. And they aren't doing it blind. They're backed by a healthy 16.2% coverage ratio.
So they have a massive rainy day fund specifically set aside to absorb those bad loans before they hit the core balance sheet.
Exactly.
So bringing this back to the market reaction and valuation, the stock is trading at roughly 14 times forward earnings, with earnings per share expected to grow 39% this year alone.
All right, and if we look at the implied valuation using a reverse DCF, which we should note is not an exact science but gives us a strong indication of what the market is pricing into the current stock price, those expectations seem, well, quite grounded given their hyper-efficient growth.
Definitely. And they're entering the U.S. market right now, but doing it very cautiously. They've strictly capped the downside risk of this U.S. expansion to just 100 basis points on their efficiency ratio for the next 2 years.
Meaning even if the U.S. launch completely stalls out, it only costs them an extra penny to generate a dollar of revenue.
It's a beautifully asymmetrical bet. So here is a final thought for you to explore. New is bringing this hyper-efficient AI-native model to America. If they achieve even a fraction of the product market fit here that they did in Brazil and Mexico, how will legacy U.S. banks bogged down by heavy physical branches and slow underwriting possibly compete with a rival that prices complex risk accurately in milliseconds?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.